Hello, friends. Welcome back to Book Demystified once again. And today we are going to discuss the book, The Bogleheads Guide to Investing by Taylor Larimore. You know what happened to me just last month that completely changed how I think about investing? I was at a coffee shop in downtown Seattle, and I overheard this conversation between two guys who looked like they were in their 60s. One of them was showing the other his investment account on his phone, and I couldn't help but notice the number at the bottom of the screen. It was over $3 million. $3 million! And here's the crazy part. The guy wasn't some Wall Street hotshot or tech entrepreneur. He was a retired high school teacher who had been investing in something called index funds for 35 years. That conversation got me curious about something I'd been hearing about but never really understood. Who are these mysterious people called Bogleheads, and why do they seem to have figured out something about investing that the rest of us are missing? What I discovered completely blew my mind, and honestly made me question everything I thought I knew about building wealth. Picture yourself for a moment, sitting in your living room, scrolling through social media, and seeing all these ads for trading apps promising you can become the next Warren Buffett by picking individual stocks. You've got influencers on TikTok showing off their gains from day trading, YouTube channels promising secret stock-picking formulas, and investment newsletters claiming they can help you beat the market. Meanwhile, you're sitting there with your modest savings account feeling like you're missing out on some exclusive club where everyone else is getting rich while you're stuck on the sidelines. But what if I told you that there's a group of ordinary people, teachers, engineers, nurses, accountants, regular folks just like you and me, who have been quietly building massive amounts of wealth using a strategy so simple it seems almost boring? What if I told you that this strategy requires no special skills, no constant monitoring of the market, no stress about picking the right stocks, and no fear of losing everything because you made the wrong bet? The story behind this approach starts with a man named John Bogle. And honestly, his story is one of the most inspiring things you'll ever hear about the investment world. Back in 1975, Bogle founded a company called Vanguard and created something that Wall Street thought was absolutely crazy. He created the first index fund available to individual investors. Wall Street hated this idea because it threatened their business model of charging high fees for actively managed funds that frankly weren't delivering better returns than the overall market. But Bogle had a radical idea. What if, instead of trying to beat the market by picking individual stocks or timing when to buy and sell, you just owned a tiny piece of the entire market? What if you could invest in the 500 largest companies in America all at once, with virtually no fees, and just let the natural growth of the American economy work for you over time? Wall Street called him crazy. They said it would never work. They said people wanted excitement and the chance to beat the market. Well, here we are, almost 50 years later, and Bogle's simple idea has created more wealth for ordinary investors than probably any other innovation in financial history. The people who followed his philosophy, who came to be known as Bogleheads, have quietly accumulated millions of dollars, while the rest of the investment world has been chasing the latest trends and fads. Let me share with you exactly what happened when I started digging into the numbers, because this is where things get really interesting. The average actively managed mutual fund, the kind where professional money managers are trying to beat the market by picking stocks and timing their trades, has underperformed the simple S&P 500 index over the last 20 years. Not by a little bit, but by a significant margin. We're talking about the difference between having $800,000 and having $1.2 million over a typical investment career. But here's what really shocked me. It's not just that active management underperforms, it's that the underperformance is so consistent and predictable that it's almost like a law of physics. Study after study, decade after decade, the results are the same. The vast majority of professional money managers with all their research teams, computer models, and insider knowledge cannot consistently beat a simple index fund that just owns everything. Now, you might be thinking, okay, but what about those managers who do beat the market? Surely some of them have special skills or insights that make them worth the higher fees. And you're right that some managers do beat the market in any given year. The problem is that past performance doesn't predict future performance. The managers who beat the market this year are no more likely to beat it next year than if you had picked fund managers by throwing darts at a board. This is where Taylor Larimore's book becomes so valuable, because he takes these academic concepts and makes them practical for real people living real lives. Taylor Larimore isn't some ivory tower professor or Wall Street insider. He's a retired airline pilot who discovered Bogle's philosophy in the 1990s and became one of the most respected voices in the Boglehead community. His book is essentially a roadmap for how ordinary people can build extraordinary wealth using the simplest possible investment strategy. The core philosophy can be summed up in just a few principles, but don't let the simplicity fool you. These principles are backed by decades of academic research and real-world results. The first principle is to invest in low-cost index funds that track broad market indices. Instead of trying to pick individual stocks or find the next hot mutual fund manager, you simply buy a fund that owns hundreds or thousands of stocks across the entire market. The second principle is to diversify across different asset classes and geographic regions. You don't put all your money in U.S. stocks. You also own international stocks, bonds, and maybe even real estate investment trusts. This diversification reduces your risk without significantly reducing your expected returns.
The third principle is to invest regularly regardless of market conditions, and to reinvest all dividends and capital gains. This is called dollar-cost averaging, and it's one of the most powerful wealth-building tools available to individual investors. By investing the same amount every month, whether the market is up or down, you buy more shares when prices are low and fewer shares when prices are high, which tends to improve your average cost basis over time. The fourth principle is to minimize taxes by using tax-advantaged accounts like 401ks and IRAs, and by holding tax-efficient index funds in your taxable accounts. Taxes can eat away at your returns just as much as high fees, so tax optimization is a crucial part of the Boglehead strategy. And the fifth principle is to stay the course no matter what. Don't panic and sell during market downturns. Don't get greedy and chase hot stocks during bull markets. Stick to your plan through thick and thin, because consistency over time is what creates wealth. Now, let me tell you about my friend Rachel, because her story perfectly illustrates how powerful this approach can be when you actually implement it. Rachel is a nurse here in Chicago, and she started following the Boglehead philosophy about 12 years ago when she was 28 years old. She was making about $55,000 per year at the time and could only afford to invest about $300 per month. Rachel didn't try to pick individual stocks or find the best performing mutual funds. She simply set up automatic investments into 3 low-cost index funds: a total stock market fund, an international stock fund, and a bond fund. She allocated about 70% to U.S. stocks, 20% to international stocks, and 10% to bonds. Every month, like clockwork, $300 came out of her checking account and was invested according to this simple allocation. Here's where the story gets really interesting. Over those 12 years, Rachel got married, bought a house, had 2 kids, and went through all the normal financial stresses that come with adult life. There were months when money was tight and she was tempted to skip her investments. There were market crashes in 2018 and 2020 when her portfolio lost significant value and she was tempted to sell everything and hide her money in a savings account. But Rachel stuck to the Boglehead principles. She continued her automatic investments through good times and bad. She reinvested all her dividends. She ignored the financial media predicting doom and gloom during market downturns. She resisted the temptation to chase hot stocks during bull markets. And you know what happened? Her portfolio is now worth over $200,000, and she's on track to be a millionaire by the time she's 50. The most amazing part of Rachel's story is how little effort it required. She spends maybe 30 minutes per year rebalancing her portfolio to maintain her target allocation. She doesn't watch CNBC or read financial newsletters. She doesn't stress about individual stock picks or worry about market timing. She just lives her life while her investments grow automatically in the background. This is the power of what Larimore calls investing made easy, and it's available to anyone regardless of their income level, education, or financial knowledge. You don't need to be a math genius or have an MBA from Wharton. You just need to understand a few basic principles and have the discipline to stick with them over time. But I know what some of you are thinking. This all sounds too good to be true. If index investing is so simple and effective, why isn't everyone doing it? Why are there still thousands of actively managed mutual funds and financial advisors promising to beat the market? The answer is actually pretty simple, and it reveals something important about human psychology and the financial industry. First, the financial industry makes a lot more money selling complex, high-fee products than they do selling simple, low-cost index funds. Think about it from their perspective. If they can convince you to buy an actively managed fund that charges 1.5% per year in fees instead of an index fund that charges 0.05% per year in fees, they make 30 times more money from your investment. There's a huge financial incentive for Wall Street to convince you that investing needs to be complicated and that you need their expertise to succeed. Second, simple and boring doesn't sell as well as exciting and complex. Which sounds more appealing? Buy this index fund and hold it for 30 years, or learn the secret stock-picking formula that could make you rich overnight. Our brains are wired to prefer excitement and the possibility of quick gains over steady, predictable progress. The financial media knows this, which is why they focus on daily market movements and hot stock picks rather than boring long-term wealth-building strategies. Third, there's something called the illusion of control that makes people believe they can outsmart the market. We want to believe that with enough research and analysis, we can find undervalued stocks or time our purchases perfectly. This illusion is so powerful that even professional investors, who have access to much better information than individual investors, continue to believe they can beat the market despite decades of evidence to the contrary. Larimore addresses all of these psychological barriers in his book, and he does it with a combination of data, logic, and real-world stories from Boglehead investors. He shows you exactly how to set up a simple 3-fund portfolio that will serve you well for your entire investing career. He explains how to choose the right asset allocation based on your age and risk tolerance. He walks you through the process of opening investment accounts and setting up automatic contributions. But more importantly, he gives you the mental framework to stick with your plan during the inevitable market volatility that will test your resolve. Because here's the thing that nobody talks about enough. Index investing isn't emotionally easy, even though it's mechanically simple. When the market crashes and your portfolio loses about 20 or 30% of its value in just a few weeks, every instinct in your body will be screaming at you to sell before you lose even more. I experienced this firsthand during the COVID-19 market crash in March 2020. I had been following the Boglehead approach for several years at that point, but watching my portfolio lose about $40,000 in just 3 weeks was genuinely terrifying. I found myself checking my account balance multiple times per day, reading every doom and gloom article about the economy, and seriously considering whether I should sell everything and wait for things to calm down.
Fortunately, I remembered what Larimore teaches about market volatility. Crashes are a normal part of investing in stocks. They happen regularly, they are impossible to predict, and they're always followed by recoveries. Instead of selling, I actually increased my monthly investments during the crash, buying more shares at lower prices. By the end of 2020, not only had my portfolio recovered, but it had reached new all-time highs thanks to those extra shares I bought at a discount. This experience taught me that knowledge alone isn't enough. You also need the emotional discipline to act on that knowledge when your instincts are telling you to do the opposite. This is why having a written investment plan is so important. When emotions are running high, you can refer back to your plan to remind yourself why you chose your strategy and why you should stick with it. Hey, if you're enjoying our free book summaries and want to support what we do, there are a few easy ways to help. You can subscribe to the channel, become a member, or grab the book using our affiliate link in the description. And if you'd like to go a step further, you can also leave a tip via PayPal or UPI. The link's below. Every bit of support helps us keep creating valuable content for you. Now, One of the most valuable sections of Larimore's book deals with practical implementation, because knowing the theory is one thing, but actually putting it into practice is where most people get stuck. He walks you through exactly how to build what Bogleheads call a three-fund portfolio, which is essentially the simplest possible diversified investment strategy. The three funds are a total stock market index fund, which gives you ownership in virtually every publicly traded company in the United States, an international stock index fund, which gives you exposure to companies in developed and emerging markets around the world, and a bond index fund, which provides stability and income through government and corporate bonds. For a young investor in their 20s or 30s, Larimore typically recommends an allocation of about 80 to 90% stocks and 10 to 20% bonds, with the stock portion split roughly 70% US and 30% international. As you get older and closer to retirement, you gradually shift to a more conservative allocation with a higher percentage of bonds. The beauty of this three-fund approach is that it gives you exposure to thousands of companies across multiple asset classes and geographic regions with just three low-cost funds. You're not trying to pick winners or time the market. You're simply owning a small piece of the global economy and letting compound growth do its work over time. Let me give you a specific example of how this might work in practice. Let's say you're 25 years old, making $45,000 per year, and you can afford to invest $400 per month. You open a Roth IRA with a low-cost broker like Vanguard, Fidelity, or Schwab, and you set up automatic investments of $320 per month into a total stock market index fund, $80 per month into an international stock index fund, and $0 into bonds because you're young and can tolerate more risk. Every month, like clockwork, $400 is invested automatically according to this allocation. You don't have to think about it, research individual stocks, or worry about market timing. You just live your life while your investments grow in the background. Once per year, you spend about 30 minutes rebalancing your portfolio. This means selling some of whichever fund has performed better and buying more of whichever fund has performed worse, bringing your allocation back to your target percentages. This rebalancing forces you to sell high and buy low, which is exactly what you want to do as an investor. If you follow this simple strategy from age 25 to 65, investing $400 per month and earning the historical average return of about 7% after inflation, you'll retire with approximately $1.6 million. That's enough to support a comfortable retirement without ever having to pick a single stock or try to time the market. But here's where things get really interesting. Larimore also explains how to supercharge this strategy by taking advantage of tax-advantaged accounts and employer matching programs. If your employer offers a 401k plan with matching contributions, this should be your absolute first priority before you even think about taxable investing. Let me tell you about my coworker Mike, who works in IT and makes about $70,000 per year. His company matches 50% of his 401k contributions up to 6% of his salary. So if Mike contributes 6% of his salary, which is about $4,200 per year, his company adds another $2,100 to his account. That's an instant 50% return before any market gains. Mike has been maximizing his employer match for the last 8 years, and between his contributions, his employer match, and investment growth, his 401k is now worth about $90,000. But here's the kicker. Mike is also saving money on taxes because his 401k contributions reduce his taxable income. At his tax bracket, he saves about $900 per year in taxes by contributing to his 401k. So not only is Mike getting free money from his employer, but he's also reducing his current tax bill while building wealth for the future. This is why Larimore emphasizes that tax-advantaged accounts should be the foundation of any investment strategy.
For those who don't have access to a 401k or who want to invest beyond their employer plan, Larimore explains the benefits of individual retirement accounts. Traditional IRAs work similarly to 401ks, with tax-deductible contributions and tax-deferred growth. Roth IRAs are funded with after-tax dollars, but offer tax-free growth and tax-free withdrawals in retirement. The choice between traditional and Roth accounts depends largely on your current tax bracket versus your expected tax bracket in retirement. If you're currently in a high tax bracket and expect to be in a lower bracket in retirement, traditional accounts usually make more sense. If you're currently in a low tax bracket and expect to be in a higher tax bracket in retirement, Roth accounts are typically better. For most young investors, Roth accounts are particularly attractive because you're likely in a relatively low tax bracket early in your career. You pay taxes on your contributions at today's rates, but then decades of compound growth happen completely tax-free. Imagine having $1 million in your Roth IRA when you retire and being able to withdraw all of it without paying a single cent in taxes. Larimore also addresses one of the most common questions that beginning investors have. What about international diversification? Should you invest only in U.S. companies, or should you also own international stocks? His answer, backed by academic research, is that international diversification can improve your risk-adjusted returns over time. While the U.S. stock market has performed exceptionally well over the long term, there have been extended periods when international markets outperformed U.S. markets. By owning both U.S. and international stocks, you reduce the risk that all of your investments will perform poorly at the same time. The Boglehead approach typically recommends allocating about 20 to 40% of your stock investments to international funds. This gives you exposure to companies in Europe, Japan, and emerging markets like China, India, and Brazil. You're essentially betting on the growth of the entire global economy rather than putting all your eggs in the U.S. basket. One of the sections in Larimore's book that I found particularly eye-opening deals with the cost of investment fees and how they compound over time. Most people don't realize how much high fees can erode their returns, but the numbers are truly staggering when you look at them over a full investment career. Let's say you have two identical investors who each invest $500 per month for 30 years and earn the same 8% annual return before fees. Investor A chooses low-cost index funds with an expense ratio of 0.05% per year. Investor B chooses actively managed funds with an expense ratio of 1.5% per year. After 30 years, Investor A will have about $740,000, while Investor B will only have about $550,000. That 1.45% difference in fees cost Investor B almost $200,000 in lost wealth. This is why Bogleheads are so obsessed with keeping costs low. Every dollar you pay in fees is a dollar that can't compound and grow over time. Over a full investment career, the difference between low-cost and high-cost investments can literally be the difference between a comfortable retirement and having to work until you die. The good news is that low-cost index funds are now widely available from multiple fund companies. Vanguard, which John Bogle founded, is probably the most famous, but Fidelity and Schwab also offer excellent low-cost index funds. Many of these funds have expense ratios below 0.1% per year, which means you pay less than $1 in fees for every $1,000 invested. Larimore also spends considerable time discussing the importance of asset allocation, which is how you divide your investments between different asset classes like stocks and bonds. Your asset allocation is probably the most important decision you'll make as an investor, more important than which specific funds you choose or when you buy and sell. The general rule of thumb is that younger investors can afford to take more risk because they have more time to recover from market downturns. A common guideline is to subtract your age from 100 or 110 to determine your stock allocation. So if you're 30 years old, you might put 70 to 80% of your portfolio in stocks and 20 to 30% in bonds. As you get older, you gradually shift toward a more conservative allocation. By the time you're in your 60s and approaching retirement, you might have 50 to 60% stocks and 40 to 50% bonds. The idea is that when you're young, you can afford to ride out the volatility of the stock market because you have decades for your investments to recover from any downturns. As you get closer to needing your money, preserving what you've accumulated becomes more important than growing it aggressively. But here's something that Larimore emphasizes that I think is crucial. Your asset allocation should be based on your personal risk tolerance, not just your age. Some people are naturally more conservative and would lose sleep if their portfolio dropped by 30% during a market crash. Others are more aggressive and can handle significant volatility without panicking.
The key is to choose an allocation that you can stick with during both good times and bad times. There's no point in having an aggressive allocation that causes you to panic and sell during market downturns. It's better to have a more conservative allocation that you can maintain consistently over time. One of my favorite stories from the book involves a Boglehead named Frank who retired in 2000, right before the dot-com crash and the worst bear market in decades. Frank had been following the Boglehead philosophy for years and had accumulated about $800,000 in his retirement accounts. When the market crashed and his portfolio lost about 40% of its value, Frank's friends and family urged him to sell his stocks and move to cash before he lost even more. But Frank stuck to his plan. He continued to rebalance his portfolio, buying more stocks as prices fell. He lived off his bond allocation and Social Security while waiting for the stock market to recover. And recover it did. By 2007, Frank's portfolio had not only recovered, but had grown to over $1 million. Even after living off his investments for 7 years, he had more money than when he retired. Frank's story illustrates one of the most important lessons in Larimore's book: the importance of having a plan and sticking to it regardless of short-term market movements. The stock market is volatile in the short term, but it has been remarkably consistent in delivering positive returns over longer periods. This brings us to one of the most challenging aspects of index investing: the psychological discipline required to stay the course during market volatility. Larimore devotes significant attention to this topic because he understands that knowledge alone isn't enough. You also need the emotional fortitude to act on that knowledge when your instincts are telling you to do something else. During bull markets, when stocks are hitting new highs and everyone seems to be getting rich, the temptation is to abandon your disciplined approach and chase hot stocks or speculative investments. During bear markets, when your portfolio is losing value and the financial media is predicting economic doom, the temptation is to sell everything and hide your money in cash. Both of these impulses are natural and understandable, but they're also wealth-destroying. The investors who build real wealth over time are the ones who can ignore these impulses and stick to their long-term plan regardless of short-term market movements. Larimore suggests several strategies for maintaining discipline during volatile periods. First, limit how often you check your account balance. Checking your portfolio daily or even weekly serves no useful purpose and only increases the emotional stress of investing. Most Bogleheads check their accounts monthly or quarterly at most. Second, focus on your contributions rather than your account balance. You can control how much you invest each month, but you can't control short-term market movements. By focusing on what you can control, you're less likely to make emotional decisions based on market volatility. Third, remember that market volatility is the price you pay for higher long-term returns. If investing in stocks was guaranteed to be smooth and predictable, the returns would be much lower. The volatility that scares most investors away is exactly what creates the opportunity for higher returns over time. As we wrap up our discussion of Larimore's book, I want to share the key takeaways that can transform your financial future if you implement them consistently. The Boglehead philosophy isn't just about investing, it's about adopting a mindset that prioritizes long-term wealth building over short-term excitement. First, keep it simple with a basic 3-fund portfolio of low-cost index funds.
You don't need dozens of different investments or complex strategies. A simple mix of U.S. stocks, international stocks, and bonds will serve you well for your entire investing career. Second, minimize costs by choosing funds with low expense ratios and avoiding frequent trading. High fees are a wealth destroyer, and they compound over time just like investment returns. Every dollar you save in fees is a dollar that can grow and compound for your benefit. Third, diversify across asset classes and geographic regions to reduce risk without sacrificing expected returns. Don't put all your money in one type of investment or one part of the world. Spread your risk while maintaining your growth potential. Fourth, invest regularly regardless of market conditions and reinvest all dividends and capital gains. Dollar cost averaging smooths out market volatility and ensures that you buy more shares when prices are low and fewer shares when prices are high. Fifth, maximize tax-advantaged accounts before investing in taxable accounts. The tax savings from 401ks and IRAs can add hundreds of thousands of dollars to your long-term wealth, especially when combined with employer matching contributions. Sixth, choose an asset allocation appropriate for your age and risk tolerance and rebalance periodically to maintain your target allocation. This forces you to sell high and buy low, which is exactly what successful investors do. And finally, stay the course through market volatility and ignore the noise from financial media and market predictions. Consistency over time is what builds wealth, not trying to time the market or chase hot investment trends. The beautiful thing about the Boglehead approach is that it's available to everyone, regardless of income, education, or financial knowledge. You don't need to be rich to start. You don't need special skills or connections, and you don't need to spend hours researching investments or monitoring the market. You just need to understand these basic principles and have the discipline to implement them consistently over time. Your future self will thank you for starting today. Whether you begin with $50 per month or $500 per month, the important thing is to begin. Open those investment accounts, set up automatic contributions, choose simple index funds, and let the power of compound growth start working for you. Remember, every millionaire Boglehead started exactly where you are right now. They weren't born with special advantages or secret knowledge. They simply discovered the power of low-cost index investing and had the patience to let it work over time. That same opportunity is available to you today, and it all begins with the decision to start investing in your future.